All right, let's dive into something pretty fascinating today.
Yeah.
We're going to be talking about the early investing career of, well, you know him, Warren Buffett.
Of course.
But what was he like before all the billions and the fame, you know?
Right. But before he was the
I
Oracle of
mean,
Omaha.
yes. So to get some insight into that,
Yeah.
we're going to be looking at a collection of his partnership letters
Okay.
that he wrote between 1956 and 1969.
Wow.
Now, what's pretty cool about these, they were private for decades.
Oh, really?
Yeah, so this is kind of like a sneak peek behind the curtain, you know?
That's amazing to see how his investment philosophy
Yeah,
developed.
exactly.
So we're looking at like the
Yeah,
foundation.
the foundation, exactly.
Yeah.
So let's set the scene. It's 1956, Omaha, Nebraska.
Small town.
Small town, yeah.
Yeah.
You've got this young Warren Buffett, fresh from his studies under the legendary Benjamin Graham.
The Godfather.
The Godfather, exactly.
A value investing.
And he decides to launch
Okay.
his own investment partnership.
All right.
Buffett Partnership LT, or BPL for short.
Gotcha. BPL.
BPL, there you go.
Yeah, and that's
Yeah.
interesting how he
Yeah.
Structured BPL.
Yeah.
It was kind of modeled after Graham's partnerships, but
Yeah.
with a little twist.
Yeah.
Partners could actually withdraw a portion of their funds each month
Really?
if they needed income.
No, that seems
Yeah.
kind of counterintuitive, right?
It does.
For a long-term investment.
Yeah, you would think like long term
Yeah.
you're locked in, but
Say.
I think it was really smart how he did that because it aligned incentives
Okay.
and attracted a wider range of partners.
That's a good point. Yeah, yeah.
It let, if somebody
Yeah.
needed some liquidity. they
Yeah,
just-
exactly. Yeah. And he could keep
Yeah.
his long-term focus.
Exactly.
Very smart.
It was brilliant.
Yeah. And of course, Buffett had his own skin in the game, too,
Right.
right? He had his own money
Oh yeah, of course, yeah.
in the partnership.
To show,
Yeah,
he's
insert
in it
in.
with you.
Yeah, exactly.
Right.
So let's actually talk about how he invested the money.
Okay, all right.
In his letters, he outlined three main categories:
Okay.
generals, workouts,
All right.
and controls.
So these are like his different buckets.
Buckets, yeah,
Over.
different strategies.
Gotcha.
So starting with generals,
Yeah.
what exactly were those?
Okay, so think of generals as like the bread and butter
Okay.
of value investing.
Right.
These were undervalued securities that Buffett identified
Okay.
using both quantitative analysis, so like
Yeah.
digging through financial statements,
Okay.
and also qualitative analysis.
Okay.
So like understanding the business itself.
Gotcha. So it's not just
Right, numbers.
here's a story.
It's the story behind the numbers.
Yeah. Okay. Interesting.
And the key here is that he wasn't just looking for
Yeah.
cheap stocks.
Right.
He was looking for good businesses,
Okay.
selling at a discount to their intrinsic value.
So he was already using those principles from
Yep.
Benjamin Graham.
Exactly.
Okay.
Carrying the torch.
I'm curious, how did he determine that intrinsic value?
Okay, so that's where the concept of margin of safety comes in.
Okay.
So he would analyze a company's assets, earnings, and their future prospects
Uh-huh.
to estimate its intrinsic value.
Right.
Then, and this is key, he'd only buy if the stock was trading at a significant discount
Okay.
to that estimated value.
So that's that margin of safety.
That's the margin of safety.
providing a cushion.
It's a cushion.
Yeah, like a buffer.
Yeah, like a buffer against
Yeah.
unforeseen events,
Oh.
or errors in his own judgment.
That's interesting. So it's not just about finding a good company. It's
Right.
about buying it at
At the right price.
the right price.
Yeah.
Makes a lot of sense.
It's both sides of the equation.
Yeah. Do the letters give us any specific examples
Yes, they do.
of these?
There's a fascinating story
Okay.
about Commonwealth Trust Company.
Right.
BPL started accumulating shares in this bank,
Okay.
but it wasn't really like
Yeah.
a glamorous or a high-flying stock.
Yeah.
Now, it barely traded.
Really?
Yeah, but Buffett saw value in its underlying assets
Uh-huh.
and patiently
Yeah.
built up a significant position over time,
Interesting.
held it for years,
Oh, wow.
demonstrating his long-term outlook
Okay.
and his belief in the power of compounding.
It sounds like patience is a...
Huge,
Yeah.
big theme here.
Yeah.
Okay, let's move on to workouts.
All right. So workouts,
What were those all about?
those were special situations.
Okay.
Investments driven by corporate events like mergers, spin-offs, reorganizations, things like that.
Interesting. Okay. So it's like event-driven investing.
Yeah, it is. You're trying to profit
Yeah.
from those actions.
Exactly. And the appeal for Buffett was the predictability.
Okay.
So he could often foresee the outcome of these events
Mm-hmm.
within a reasonable time frame,
Interesting. Okay.
which reduced his risk
Okay.
and allowed him to capitalize on market inefficiencies.
That's really interesting. Is there a particular story from the letters?
Yes.
Okay.
One that stands out is the investment in
Okay.
Texas National Petroleum, or TNP.
TNP.
TNP, yeah. And this was,
Okay.
it was a really complex situation.
Really?
It involved the corporate restructuring, IRS rulings,
Oh.
even bond conversions.
Oh my gosh.
So Buffett had to,
Yeah.
navigate this intricate web of events
Yeah.
with remarkable skill.
Really?
Yeah, but ultimately generated significant profits.
Wow. It sounds like he almost thrived on these complex situations.
He did.
It must have taken a lot of research
Well,
to really understand.
And it highlights another key aspect
Mhm.
of Buffett's investing.
Yeah.
He wasn't afraid to dig deep
Okay.
and understand the intricacies of a situation.
Yeah.
He didn't just rely on surface level information.
Right. He had to get in there and
Yeah, get his hands dirty.
really understand.
Yeah, yeah.
Okay. So he wasn't just a stock picker.
Right.
He was a business analyst.
He was an analyst.
Wow. Okay. All right. Let's move on to the final category.
Okay.
Controls.
Now, this is where things get really interesting.
Okay.
So controls represented a shift for Buffett.
Right.
These were situations where BPL
Yeah.
acquired a controlling stake
Okay.
in a company,
Right.
allowing him to actively influence
Okay.
management decisions and really shape
Okay.
the company's future.
So the partnership letters give us a glimpse into Buffett's
Evolution.
evolution from a passive investor
Yeah.
to more of a hands-on
Operator.
operator. Wow, that's
Yeah.
fascinating.
Yeah.
Okay, so he's going from the sidelines
Yeah, he's getting
onto the field.
Yeah, he's on the field now.
Wow, and the story of Dempster Mill
Yeah.
really illustrates this.
Yeah.
So Dempster was...
It was a farm implements manufacturer.
Okay.
He was struggling.
All right.
And Buffett saw an opportunity
Yeah.
to unlock value by acquiring
Okay.
a controlling stake,
Oh.
implementing a turnaround strategy.
So classic value play.
Classic value play.
He's getting his hands dirty.
Yeah, he's in the operations.
Wow, it sounds like he really
He did.
relished those challenges.
Yeah, he liked fixing things.
Wow. Okay, so we've got these three categories. Generals, workouts,
Yeah.
controls.
3 buckets.
They really paint a vivid picture
do.
of his investing approach during those years.
Yeah.
I'm curious, as BPL grew
Yeah.
and accumulated more capital,
Right.
did he face any challenges in maintaining this approach?
Yeah, that's a great question.
Yeah.
And one that Buffett himself grappled with
Yeah.
as BPL's assets just ballooned.
Yeah.
He recognized the inherent tension
Okay.
between size and performance.
Okay.
So on the one hand, larger funds could participate in bigger control situations
Right.
and, potentially generate outsized returns.
Yeah.
But on the other hand, too much capital could dilute returns in other areas,
Okay.
making it harder to find attractive investments that could really move the needle.
It's almost like trying to steer a giant ship in a small harbor.
It's a great analogy.
Yeah, you got all this power, but you don't have
Not much room to maneuver.
the maneuverability.
Yeah.
Okay, so how did he address that? Did he?
So he used a great analogy in his letters.
Okay.
He said he wanted to keep a 10% lead of ideas over capital.
Wow. What does that mean?
Yeah, so what that means is he wanted to make sure that he always had more promising investment ideas
Yeah.
than he had money to invest.
So it's almost like he had a backlog.
Yeah, it's a backlog.
Or ideas.
A backlog of
Yeah.
ideas.
Yeah.
And it was a way to ensure that the size of the fund didn't become a detriment to his performance.
Interesting. So it's all about quality over quantity.
Always. Always.
Yeah.
That's the through line.
It's amazing to see these core principles
Yeah.
guiding his decisions.
From the beginning.
From the beginning.
Yeah, it's all there.
Yeah, really fascinating.
I find that fascinating as well.
So we've seen these different categories, but
Yeah,
these principles were tested in
Well-
the real world.
absolutely.
And as we move into the next part of our deep dive,
Good.
we're going to fast forward to the 1960s,
All right.
a time of incredible market exuberance,
The go-go years.
the go-go years.
That's what they call them, yeah.
And we're going to see how Buffett navigated
Yeah,
this period of
speculative friends.
speculative frenzy. Exactly.
Yeah.
So stay tuned for part 2.
Buckle up.
Buckle up. It's going to be a wild ride.
It's gonna good.
I think so. Welcome back to our deep dive into Warren Buffett's partnership letters.
Okay.
We're picking up where we left off, talking about the challenges of,
Managing a growing fund.
right.
But now we're going to fast forward to the 1960s,
Right.
a time of incredible market exuberance.
Exuberance, yeah.
Often called the go-go years.
That's right, the go-go years.
I'm really curious to see how Buffett navigated this period of
speculative frenzy.
Speculative frenzy, yeah.
Yeah. This is where we see Buffett's independent thinking
Okay.
and discipline really shine.
Okay.
So while many investors were swept up in the euphoria,
Right.
chasing the next hot stock,
Yeah, trying to get those quick gains.
yeah, embracing risky strategies,
Mm-hmm.
Buffett remained grounded
Okay.
in his value-oriented approach.
So he wasn't tempted to ride that wave.
Not at all.
Maybe loosen his criteria a little bit.
He stuck to his guns.
Capture some of those gains.
Yeah, he saw disconnect
Okay.
between those soaring stock prices and the underlying business fundamentals.
And he became increasingly cautious.
Okay, so he was sounding the alarm bells.
Yeah, a little bit. Yeah.
Internally, at least.
Yeah, he was recognizing that things were getting a little out of hand.
Okay.
He was actually quite critical
Really?
of the go-go investing style,
Okay.
popularized by funds like Jerry Tsai's Manhattan Fund.
Okay. Yeah, I've heard of that.
Yeah, so these funds were
Yeah.
achieving spectacular returns
Right.
by rapidly buying and selling stocks.
So they're just churning the portfolio,
looking
for those quick gains.
Momentum and speculation.
Right.
Rather than fundamental analysis.
Buffett really...
He did not like this.
He did not like this, no.
No, he saw it as a dangerous game.
Okay.
And he warned that, such high-flying performance often attracted a flood of new investors right before things turned sour.
It's like a house of cards.
Exactly.
It looks good. It looks impressive.
Yeah, it looks great.
But it's not stable.
But it's built on a shaky foundation.
Yeah, exactly. And, looking back at the go-go years, what happened?
It all came crashing down.
Yeah. So Buffett's letters from this period really reveal this growing concern, yeah.
Yeah, about this speculative fever.
Right.
He understood that trees don't grow to the sky, and that unsustainable growth eventually leads to a correction.
Okay, so what did he do?
Okay, so he didn't try to time the market precisely.
Okay.
But he did make a bold decision.
Okay.
In 1969, at the peak of his success.
Oh, wow.
With the partnership.
Okay.
He decided to close it down.
He closed BPL?
He closed BPL.
Wow. That is...
Can you imagine?
Oh, I can't even imagine.
You're at the top of your game, best returns ever, and you just say,
I'm done.
I'm out.
Wow.
Yeah. He cited a scarcity of good investment ideas and an increasingly speculative environment that he felt uncomfortable navigating.
So he was basically saying,
I'd rather return your money than invest it unwisely.
Wow. That takes incredible discipline.
Does.
To walk away.
From a winning streak.
Yeah.
Because you see danger ahead.
Yeah.
It's almost counterintuitive.
It is, yeah.
But it speaks volumes.
Yeah.
About his integrity and his commitment to his partners.
Yeah, he wasn't willing to risk their capital.
In a market that he considered overheated.
Right. He was being prudent.
Yeah, he was being prudent and, it's a powerful lesson in knowing when to hold back. Yeah. Even when everyone else
seems to be rushing in.
Is rushing in, like FOMO. FOMO, yeah, exactly. It reminds me of that old saying.
What's that?
Be fearful when others are greedy.
Yeah.
And greedy when others are fearful.
It sounds like he was embodying that. Yeah. Okay, so we've seen how Buffett navigated the go-go years.
Yeah.
But his partnership letters also reveal some valuable insights into other aspects of investing.
Okay.
Like taxes.
Oh, yeah.
Not the most exciting topic.
Not the sexiest topic?
No.
But
it's important.
Hey, keeping more of what you earn.
It's always good.
Always good.
Yeah.
Right. So I'm curious.
So Buffett was keenly aware of the impact of taxes on investment returns.
Okay.
He once said that surprising number of investors make poor decisions based on fuzzy tax considerations.
Okay.
He believed that while minimizing taxes is important, it should never come
Yeah.
at the expense of maximizing returns.
So it's about finding that balance.
Balance, yeah.
Yeah.
Making smart tax decisions without letting those decisions drive your overall investment strategy.
Okay, that makes sense.
Yeah, he was a strong advocate for paying taxes.
Oh. But at the lowest rates possible.
Of course.
He understood the tax code, and he used it strategically to his advantage.
Okay.
But he never let tax considerations dictate his investment choices.
His primary focus was on owning the most attractive
securities available, even if it meant triggering a taxable event.
So he wasn't afraid to sell a winner.
Sell a winner and pay the taxes.
And pay the taxes.
Yeah.
If it meant
redeploying that capital into something even better.
Even better, yeah. So constantly looking.
Always for improvement.
Yeah, and he understood the power of compounding.
Right.
And that meant constantly seeking out the best opportunities, even if it resulted in a short-term tax hit.
So short-term pain.
Yeah, short-term gain.
Yeah. He believed that over the long run.
Yeah.
Owning great businesses, letting those earnings compound would far outweigh any tax savings from holding on to mediocre investments.
Right. So don't let the tax tail wag the investment dog.
Love that analogy.
All right. So are there any specific strategies he had?
Yeah. One strategy he often employed was using what he called deferred tax liabilities, or DTLs.
DTLs, okay.
Essentially, this involves structuring investments in a way that allows you to defer paying taxes on gains.
So you get to
let that money
use that money
compound for longer.
So it's like
an interest-free loan from the government.
Yeah. Okay. Interesting.
In a way, yeah.
Oh.
And remember, even back then, Buffett recognized the allure of tax-free investments.
Like municipal bonds.
Like munis, yeah.
Yeah.
But he pointed out that while the tax benefits can be appealing, investors should always compare the after-tax returns to other investment options.
Yeah, it's not just about being tax-free.
Right.
It's about
the total return.
The overall return.
The overall picture.
Okay, so let's shift gears a bit and talk about another concept that Buffett emphasized.
Yeah.
Conservatism.
Conservatism.
Now, I think when most people hear that word, they think about
playing it safe.
Playing it safe.
Yeah.
Sticking to those low-risk, low-return investments.
Right. Hiding under the mattress.
Yeah, but Buffett had a different
definition.
Right.
His idea of conservatism wasn't about avoiding risk altogether.
Right.
It was about managing risk intelligently.
Okay.
He argued that true conservatism is about independent thinking.
Okay.
Applying sound reasoning.
So it's about the process.
Yeah, it's the process letting facts, not emotions or popular opinion, guide your decisions.
So you can be conservative in your approach.
But still make bold bets.
Make bold bets, okay.
Yeah.
All right, so
it's about being conservative in your process.
Not necessarily in your...
Not in the choices.
Investment choices,
He emphasized the importance of understanding your circle of competence.
Okay, now what does that mean?
So knowing what you know.
Okay.
And more importantly, what you don't know.
Right.
And not being afraid to concentrate your investments in your best ideas.
It reminds me of his famous quote about diversification.
What's that?
He said, diversification is protection against ignorance.
Oh, yeah.
It makes very little sense if you know what you're doing.
I love that quote.
It's a good one.
It is.
So how did he measure the success?
Yeah, great question.
Of his conservative approach?
He had a very practical way of testing it.
Okay.
He looked at how his portfolio performed in declining markets.
Oh, interesting. Okay.
He believed that a truly conservative portfolio should hold up better than the market.
During downturns.
During downturns, yeah.
So it's not just about how much you make on the upside.
Right.
It's how much you can protect.
It's about weathering the storm.
On the downside.
Yeah.
And consistently BPL outperform.
During those down periods.
Wow. Okay.
And that was his proof.
Yeah.
That his approach, even though it involved
the concentrated bets,
was ultimately more conservative than just owning a diversified basket of mediocre businesses.
It really challenges this conventional wisdom about what it means to be conservative.
Yeah.
Okay, we've talked about taxes.
Yeah.
Conservatism. But what about the process?
Okay, the process.
Of picking these investments.
This is where Buffett's deep understanding of businesses really comes into play. He stressed the importance of thoroughly analyzing a company's financial statements. Understanding its competitive position in the market. And even getting to know its management team.
Wow, he's really doing his homework.
He is. He really is.
So it's not just...
Yeah, it's more than just...
looking at numbers on a spreadsheet.
Yeah, it's more than just crunching numbers.
It's understanding.
It's about understanding the business from the ground up.
And he really enjoys that process.
Yeah, he sees it as an intellectual exercise.
Really?
Yeah.
Wow, okay, so...
He enjoys the learning.
He's constantly learning?
He's a learning machine.
Wow, and he had some pretty strong opinions.
He did.
About how many businesses an investor...
should own.
Yeah, should own, yeah. He
wasn't a fan of those overly...
No, he was highly critical.
Yeah, diversified portfolios.
He was. He called it the Noah School of Investing.
No.
Two of everything.
Oh, I get it. I get it. Okay, all right.
He believed that.
Yeah. True understanding and conviction come from focusing on a select group of companies.
Okay, so what was his magic number?
He actually said that if you could identify 6 wonderful businesses, that's all the diversification you need.
Okay.
He believed that putting more money into
your best idea is better than adding that 7th or 8th.
Than watering it down.
Right. Yeah. So depth over breadth.
Depth over breadth.
Yeah. Okay. Interesting.
Yeah. Focus your energy. Your resources on those high conviction ideas.
But didn't Buffett eventually move away from this concentrated approach?
He did.
When he took over Berkshire Hathaway?
That's right. But
didn't he start acquiring a wider range?
You got to remember the context.
Okay. Yeah.
When he started out, Berkshire was a struggling textile company.
Okay.
A classic cigar butt.
Okay.
Cheap business.
Right.
Some assets that could be squeezed.
For that last puff.
For one last puff.
Yeah.
Before being discarded.
Yeah.
But as Berkshire grew and evolved. So did Buffett's investment approach.
Okay.
He began focusing on acquiring high-quality businesses.
Okay.
With strong competitive advantages.
Right.
Companies that could compound their intrinsic value.
Yeah.
Over long periods.
Okay.
So he was adapting
to the
his strategy to the opportunities available to him at different stages.
So we shouldn't be too rigid.
Exactly.
In our approach either.
You have to be flexible, adaptable, and always willing to learn. And adjust.
That's great advice.
I try to follow it myself.
Okay, so we've talked about taxes, conservatism, portfolio construction, evolution of Buffett's approach. But the big question I think that's on everyone's mind is...
how do we apply this?
How do we apply these principles
in today's world?
And it's a very different landscape.
It is.
Than the 50s and 60s.
That's a great point,
Right. We're bombarded with information.
So much information.
Stock prices can swing.
Wildly.
On a tweet.
Yeah, single tweet.
Right.
And
it feels like everyone's
looking for that.
For that next hot tip.
That next hot tip, right.
It's like this big thing.
Yeah, exactly. It's easy to get swept up.
In the hype.
In all the hype.
And lose sight of...
fundamentals.
The fundamentals. So how do we cultivate that Buffett-esque discipline amidst all this noise?
That's the $1 million question.
It is.
And that's what we're going to tackle. Head on. In the final part of our deep dive.
So stay tuned for part 3.
Buckle up.
It's going to be good. Okay. We're back for the final part of our deep dive into Warren Buffett's partnership letters.
Right.
We've learned a lot.
We have.
About his investment philosophy.
Yeah, his approach to risk, taxes.
Yeah, really fascinating stuff.
It is.
But now comes the real challenge, right?
The real challenge,
Applying these principles in today's world.
In today's world.
It's a very different world.
It's a different beast.
In the 50s and 60s.
Yeah, we're bombarded with information.
Yeah, 24/7 news cycle.
Constantly.
Stock prices can swing wildly on a single tweet.
Oh, absolutely. Yeah, sentiment changes so fast.
Yeah.
It's hard to keep up.
And it feels like everyone's chasing.
That hot tip.
The next hot tip, yeah.
Yeah.
So how do we cultivate that Buffett-esque discipline?
Right, amidst all this noise.
Yeah, how do we avoid falling into...
FOMO.
FOMO, speculation, emotional decision-making.
It starts with understanding yourself. What are your financial goals?
Okay.
What's your risk tolerance?
Yeah.
Are you investing for the long term or looking for quick gains?
Yeah.
Once you have that, understanding of your objectives, then you can start to build a strategy.
That makes sense.
That aligns with those goals.
Yeah. Yeah. If you're chasing those quick riches.
Right. Then you're playing a different game.
You're playing a different game than Buffett.
Totally.
Yeah.
He was always in it.
Yeah.
For the long game.
Yeah. Building lasting value.
Yeah. Understanding those businesses.
Yeah.
Their intrinsic worth.
And remember, even Buffett didn't get everything right.
No, he made mistakes.
He made mistakes.
But he learned from them.
And I think one of the most valuable lessons from his letters is that
continuous learning.
Continuous learning.
Yeah, he was always reading, always curious.
So even the Oracle of Omaha never stopped.
Never stopped learning.
Yeah, that's inspiring.
I find it inspiring too.
Yeah, it shows that investing
is a journey.
Is a journey, not a destination.
Not a destination. Yeah, you got to keep evolving, adapting.
Yeah.
Refining your approach.
It's a lifelong pursuit.
It is. And especially today with, technology changing so rapidly.
Yeah, things are moving fast.
It's not enough to just rely on what worked in the past.
Right.
You got to be open to new ideas.
Okay, so we need to define our goals.
Right.
Understand our risk tolerance.
Yeah.
Commit to continuous learning.
Keep learning.
But what about the actual process of picking investments?
Okay, so Buffett's emphasis on independent thinking.
Yeah.
It's more important today than ever.
Yeah.
Don't just follow the headlines.
Yeah. Or chase the latest trends.
Yeah, all the hot stocks.
Right.
Do your own research.
Okay.
Develop your own criteria.
Yeah.
For evaluating businesses.
Okay.
Don't be afraid to go against the crowd.
Yeah, be a contrarian thinker.
Be a contrarian.
Yeah, like Buffett.
Like Buffett.
Who often found opportunities in those overlooked companies.
Yeah, the ones that everyone else dismissed.
So he wasn't afraid to be different.
He embraced it.
Yeah, and even in today's market, I believe there are still opportunities.
There are, yeah.
To find those undervalued businesses.
They're out there.
Yeah, they might not be the flashy.
Right, not the
tech darlings.
Not the meme stocks.
We're the meme stocks.
Yeah, those are.
But they're out there.
They're out there.
It takes patience.
Patience, discipline.
And a willingness to really
beyond the hype.
Beyond the hype, yeah.
Yeah.
So sticking to those fundamentals.
Yeah. Focusing on value.
Yeah, okay. But what about all the choices we have today?
Right. So many choices.
You've got index funds, ETFs, crypto.
There's so many different vehicles.
How do we navigate this landscape?
It can be overwhelming.
It can be, yeah.
So Buffett, he wasn't a fan of excessive diversification.
Right.
But he did recognize the value of index funds, especially for those who don't have the time or expertise to pick individual stocks.
Yeah.
He even suggested that a low-cost S&P 500 index fund is a sensible choice.
For a lot of people.
Yeah, for most investors.
So it's not this all-or-nothing approach.
No, not at all.
We can take those principles.
Right, and blend them.
Yeah,
with other strategies.
Okay.
Like index investing.
So it's all about building that portfolio that really reflects
your own individual.
Yeah, your goals.
Goals and risk tolerance.
Okay, so be thoughtful.
Be thoughtful.
Be deliberate.
Deliberate, intentional.
Have a plan.
Have a plan.
Have a strategy.
And don't let your emotions rule your investment decision.
Exactly.
Right.
And remember, one of the most powerful forces in investing is the power of compounding.
Compounding, yeah. Time is on your side. Time is your friend.
Yeah.
Let that money work for you.
Well, I think we've covered
a lot of ground.
A lot of ground.
In this deep dive.
Yeah. We explored
Buffett's early.
Yeah, his early investment philosophy.
Strategies.
His challenges.
His triumphs.
But I think one of the biggest takeaways is even though these letters were written decades ago,
the
wisdom they contain is
timeless.
Those principles.
The principles of value investing, independent thinking, discipline,
long-term focus.
They're just as relevant today.
Just as relevant. Okay, so I want to leave our listener with a final thought-provoking question.
Okay, I like it.
What would Warren Buffett do?
In your shoes.
In your shoes, yeah. Take some time.
Yeah, think about that.
Reflect on those principles.
His journey.
And think about how you can apply those lessons.
To your own financial life.
To your own financial life, because...
Yeah, because even though the market has changed... human nature hasn't felt...
Right, we're still driven by...
the same emotions, the same biases.
The same temptations.
Yeah, and by understanding...
Buffett's approach.
Yeah, his mindset...
That's decision-making.
We can learn to navigate those challenges.
So effectively...
and make better decisions.
So keep learning. keep exploring.
Never stop asking questions.
Never stop asking questions.
Yeah, because as Buffett said.
What's that?
The more you learn.
The more you learn.
The more you earn.
I love that.
It's a good one. And remember, investing isn't just about making money.
No.
It's about building a secure financial future.
It's about freedom.
For yourself, your family, your loved ones.
Yeah, financial freedom.
Yeah, it's about pursuing your passions.
Yeah, living a fulfilling life.
Living a fulfilling life. Well said.
Thank you.
Well, until next time.
Happy investing, everyone.
Happy investing.